Hello everyone, welcome to Financhist. In 2025, US federal debt reached a staggering $38 trillion. That's a number so big it's hard to wrap your head around. But as shocking as that figure is, the real concern isn't just the size of the debt itself, it's how fast it's growing. This explosive growth leads to a simple, yet unsettling question. Could US debt actually hit $70 trillion by the year 2030? Now before we go any further, let's be crystal clear. There is no official forecast from the Congressional Budget Office or any other major institution that guarantees this exact number. So, why are we even talking about it? Because the current trends are so alarming that they make this question not just valid, but necessary. The US government is running massive, persistent budget deficits, meaning it spends far more than it collects in taxes. On top of that, interest costs are skyrocketing, and more new borrowing is being used just to pay the interest on old debt. If this pattern of high spending, large deficits, and elevated interest rates continues, the debt could compound much faster than most people expect. And what if another major crisis hits? A recession, a global conflict, or another pandemic could pour gasoline on this already raging fire. Whether the final number in 2030 is 60 trillion, 70 trillion, or even more, the real issue isn't the specific number, it's the trajectory. And that raises a much bigger, more fundamental question. If our national debt keeps growing at this exponential rate, what happens next? What are the consequences for the economy, for the dollar, and for every single one of us? Stick around because we're about to break it all down. First, let's understand the core engine driving this debt machine, the budget deficit. Every year, the US government spends money on everything from Social Security and Medicare to defense and infrastructure. It pays for this spending through tax revenues. When spending exceeds revenue, you get a deficit, and the government has to borrow money by issuing treasury bonds to make up the difference. This borrowing adds to the national debt. For decades, the US has been running deficits almost every single year. But recently, these deficits have ballooned to historic levels, routinely exceeding $1.5 trillion annually. Think of it like a household that consistently spends more than it earns. For a while, you can put the difference on a credit card. But eventually, the balance grows so large that just paying the minimum interest becomes a huge expense in itself. That's exactly what's happening to the US government, but on a mind-boggling scale. Now let's add the second major factor into the mix, interest rates. For over a decade following the 2008 financial crisis, interest rates were kept at historically low levels. This made borrowing incredibly cheap for the government. But those days are over. To combat inflation, the Federal Reserve has raised interest rates significantly. This means the cost for the government to borrow new money and to roll over its existing debt has shot up. In fiscal year 2023, the net interest paid on the US debt was over $650 billion. That's more than the entire federal budget for education, transportation, and agriculture combined. Projections show this number is on track to surpass $1 trillion per year very soon. This creates a vicious cycle. Higher debt leads to higher interest payments, which adds to the annual deficit, which in turn requires more borrowing, leading to even higher debt. It's a feedback loop that can quickly spiral out of control. So how do we get from 38 trillion to a potential 70 trillion in just 5 years? It's all about compounding. Let's do some back of the napkin math just to illustrate the point. Assume the US continues to run an average annual deficit of, say, $2 trillion. That adds 10 trillion to the debt by 2030, bringing the total to 48 trillion. But that doesn't account for the interest. As the debt grows, so does the interest cost. If interest rates stay elevated, those payments could add another $1 to $2 trillion per year to the deficit. Suddenly, you're looking at annual deficits closer to $4 trillion. Compounded over 5 years, that could easily add another 20 trillion or more to the debt, pushing the total well into the $60 trillion range. And this is where the black swan events come in. Our model so far assumes a relatively stable path, but what if there's another major recession? Tax revenues would plummet, and spending on unemployment benefits and other social safety nets would soar, dramatically widening the deficit. What if a new global crisis emerges, requiring trillions in emergency spending, just like we saw during the pandemic? Any one of these events could rapidly accelerate the debt accumulation. When you combine persistent structural deficits, high interest rates, and the potential for an unexpected crisis, the path to $70 trillion by 2030 starts to look less like a far-fetched fantasy and more like a plausible, albeit terrifying scenario. So what are the real-world consequences of a debt that large? It's not just an abstract number on a government spreadsheet. It has profound implications for everyone. First, there's the concept of crowding out. When the government borrows such massive amounts of money, it competes with private businesses and individuals for a limited pool of savings. This drives up interest rates for everyone. Mortgages become more expensive, making it harder to buy a home. Car loans cost more. Businesses find it more expensive to borrow money to expand and hire new employees, which can slow down economic growth. Essentially, the government's insatiable appetite for debt sucks up capital that could have been used for productive private investment. Second, a massive debt burden limits the government's flexibility to respond to future crises. If the country is already straining to make its interest payments, where will the money come from to fight the next pandemic, natural disaster, or economic downturn? The government's toolkit becomes severely limited. This could mean a weaker and slower response when we need it most, leading to more prolonged economic pain. Third, and perhaps most concerning, is the risk to the US dollar's status as the world's reserve currency. For decades, the world has trusted US Treasury bonds as the safest asset on the planet. This creates a huge global demand for dollars. But if investors, both foreign and domestic, start to question the US government's ability or willingness to pay back its debt, that trust could erode. If they start demanding much higher interest rates to compensate for the perceived risk, or worse, start selling their US bonds, it could trigger a sovereign debt crisis. This could lead to a dramatic fall in the value of the dollar, causing massive inflation as the cost of imported goods skyrockets. This isn't a prediction, but it's a risk that grows larger with every $1 trillion of new debt. So what can be done? The solutions are politically difficult, but they are mathematically simple. To slow down the growth of debt, you either have to cut spending, raise taxes, or do a combination of both. On the spending side, the biggest drivers of long-term debt are mandatory programs like Social Security, Medicare, and Medicaid. These programs are on an unsustainable path as the population ages. Reforming them is considered a political third rail, but without addressing them, it's almost impossible to get control of the long-term fiscal picture. Other areas of spending, from defense to discretionary programs, would also need to be on the table. On the revenue side, raising taxes is the other lever. This could involve raising income tax rates, corporate tax rates, or creating new forms of taxation. Of course, this is also incredibly unpopular and comes with its own economic trade-offs, as higher taxes can potentially slow down economic activity. There's no easy answer, and any real solution would require a level of political courage and bipartisan compromise that has been sorely lacking in Washington for years. Another potential factor is economic growth. If the economy grows faster than the debt to GDP ratio can stabilize or even fall, making the debt more manageable. Policies aimed at boosting productivity and innovation are crucial. However, relying on growth alone is a risky bet, especially when the debt is already compounding at such a rapid pace. In conclusion, the prospect of US debt reaching $70 trillion by 2030 serves as a stark warning. While not an official prediction, it highlights the dangerous trajectory we are on. The combination of structural deficits, rising interest rates, and the constant threat of a new crisis has created a fiscal doom loop. The consequences of inaction are severe: slower economic growth, diminished ability to respond to emergencies, and a potential crisis of confidence in the US dollar. The path forward requires tough choices and political will. It's a conversation we need to have, not out of fear, but out of a responsible desire to secure a stable and prosperous future. The numbers are daunting, but ignoring them would be the most reckless choice of all.